This tiny piece of plastic has made some people rich and trapped millions of others in debt. Which side are you on? Have you ever noticed how easy it feels to spend money with a credit card? You walk into a store, grab something you want, tap your card, and you're done. No counting cash, no checking your wallet, no immediate feeling that money just left your hands. For millions of people, credit cards are a part of everyday life. We use them to buy groceries, book vacations, order food, pay for gas, and shop online. In fact, many people use their credit cards so often that they rarely carry cash anymore. But here's the interesting question. If credit cards are so convenient, why do so many people end up drowning in debt? The truth is that a credit card is neither good nor bad by itself. It's simply a financial tool. Just like a hammer can build a house or break a window, a credit card can help you build wealth or slowly destroy your financial future. Many people see a credit card and think they're spending their own money. But that's not what's happening. Every time you swipe your card, you're borrowing money from the bank with a promise to pay it back later. And that small detail changes everything. Used wisely, a credit card can help you build a strong credit score, earn rewards, get cash back, and even provide valuable protections when making purchases. Used carelessly, it can lead to high-interest debt that grows month after month, making it harder and harder to get ahead financially. In this video, we'll uncover how credit cards really work, why banks love them so much, and how you can use them to your advantage instead of falling into the trap that catches millions of people every year. Let's start with the biggest misconception of all. Whose money are you actually spending? Let's answer the question we left hanging at the end of the last scene. When you use a credit card, whose money are you actually spending? Most people instinctively think, my money. But that's not correct. Imagine that your best friend offers to pay for your lunch today, and you promise to pay him back next month. You get the meal right now, but the money doesn't come from your pocket. It comes from your friend. A credit card works in a very similar way. Every time you swipe, tap, or enter your card number online, the bank pays the merchant immediately. The store gets its money right away. The restaurant gets paid. The airline gets paid. Then the bank sends you the bill later. In other words, you're spending the bank's money first and your own money later. This is where many people get into trouble. Our brains are naturally wired to feel the pain of spending when we hand over cash. When you physically see money leaving your wallet, your brain recognizes that you're giving something up. But credit cards remove that feeling. A quick tap takes less than a second. No cash changes hands. No immediate consequence appears. As a result, people often spend more than they would if they were using cash. Researchers have repeatedly found that consumers tend to spend significantly more when using credit cards compared to cash purchases. Why? Because the payment feels less real. The danger isn't the card itself. The danger is forgetting that every purchase creates a future obligation. A credit card allows you to move a purchase into the future. The item arrives today. The bill arrives later. That delay creates a powerful psychological illusion. You feel the reward immediately, but the cost is postponed. Banks understand this extremely well, and that's exactly why credit cards have become one of the most profitable financial products ever created. In the next scene, we'll see how banks make billions of dollars from a simple piece of plastic that fits in your pocket. If credit cards are so convenient for consumers, have you ever wondered why banks are so eager to give them away? Think about it. Banks spend billions of dollars every year advertising credit cards. They offer sign-up bonuses, cashback rewards, airline miles, hotel points, and even free gifts. Why would they do that? Because credit cards are one of the most profitable products in the financial industry. Many people assume banks make money only in customers pay interest on debt. While interest is a huge source of revenue, it's only part of the story. Banks actually earn money in several different ways every time a credit card is used. First, there are transaction fees. Whenever you use your credit card, the merchant pays a small fee to process that transaction. It may only be a small percentage, but when millions of purchases happen every day, those fees add up to enormous amounts of money. Second, there are annual fees. Some premium credit cards charge customers hundreds of dollars every year simply for the privilege of having the card. Third, and most importantly, there is interest. When cardholders don't pay their full balance by the due date, the remaining balance begins generating interest. And credit card interest rates are often among the highest rates consumers will ever pay. A small balance can quickly become a large balance if payments are delayed month after month. This is where banks make a significant portion of their profits. But here's something surprising. Banks actually love responsible customers too. People who pay on time generate transaction fees, strengthen the bank's customer base, and often use multiple financial products. In reality, banks have created a system where they can profit whether you pay your balance in full or carry debt. The difference is simple. If you're smart, you benefit from the system. If you're careless, the system benefits from you. Understanding this difference is one of the most important financial lessons you'll ever learn. In the next scene, we'll look at the hidden power of interest and why it can either work for you or against you.
Now let's talk about the force that can either help you build wealth or quietly drain your finances for years. Interest. At first glance, interest seems simple. It's the cost of borrowing money. But what makes interest so powerful is that it doesn't grow in a straight line. It grows over time, and sometimes much faster than people expect. Let's look at a simple example. Imagine you buy a new television for $1,000 using your credit card. At first, the purchase doesn't seem like a big deal. After all, it's only $1,000. But suppose you don't pay off the balance completely. The bank begins charging interest on the remaining amount. Then, next month, interest is charged again, and the month after that. Suddenly, you're not just paying for the television anymore. You're paying for the television plus the cost of borrowing the money. And the longer the debt remains, the more expensive that television becomes. This is why credit card debt can be so dangerous. Many people focus only on the monthly payment. They see a manageable number and think everything is under control. What they don't see is how much extra money may be paid over months or even years. The longer debt stays unpaid, the harder it becomes to escape. But here's the fascinating part. The same force that can hurt you can also help you. Investors call it compound growth. When your investments earn returns and those returns begin earning returns of their own, your money starts working for you. In other words, interest can either be your employee or your enemy. When you owe money, interest works against you. When you own assets, interest works for you. Most wealthy people understand this difference very well, and that is one reason why they focus on building assets rather than carrying expensive debt. The question isn't whether interest is powerful. The question is, which side of interest are you on?
Imagine receiving your credit card statement and seeing something that looks
Harmless. Minimum payment due, $35. That doesn't sound bad at all. In fact, many people look at that number and feel relieved. They think, great, I only need to pay $35 this month. And that's exactly where the trap begins. You see, the minimum payment is not designed to help you get out of debt quickly. It's designed to keep your account in good standing while allowing interest to continue accumulating on the remaining balance. Let's say you owe $3,000 on your credit card. If you only make the minimum payment each month, most of that payment may go toward interest rather than reducing the actual debt. The balance falls very slowly. Meanwhile, interest keeps working in the background, month after month, year after year. What started as a temporary debt can turn into a long-term financial burden. Many people don't realize how much extra money they will ultimately pay. A purchase that originally cost a few $1,000s can end up costing significantly more because of accumulated interest over time. The minimum payment creates the illusion of progress. You make a payment, the bank accepts it, everything appears fine. But beneath the surface, the debt often remains almost unchanged. This is one of the reasons credit card companies prominently display the minimum payment. They know it feels affordable, and affordable payments encourage people to keep carrying balances. Now, making the minimum payment is certainly better than missing a payment entirely. Late payments can damage your credit score and trigger additional fees. But if your goal is financial freedom, the minimum payment should be viewed as a safety net, not a strategy. People who become financially successful understand an important principle. They don't focus on the smallest payment possible. They focus on eliminating high-interest debt as quickly as possible. Because every month that debt survives, interest continues collecting its paycheck. And unfortunately, that paycheck comes from your wallet.
Up to this point, we've talked a lot about the dangers of credit cards. But now it's time to discuss something many people don't realize. Credit cards can also be powerful financial tools. In fact, when used responsibly, a credit card can help you save money, qualify for better loans, and build a stronger financial future. The key is understanding something called a credit score. Think of your credit score as your financial reputation. Just as employers look at your work history before offering you a job, lenders look at your credit history before lending you money. Your credit score helps banks answer one simple question: can this person be trusted to repay borrowed money? Every time you use credit responsibly, you're building evidence that you can. Making payments on time, keeping balances low, avoiding missed payments. These habits gradually strengthen your credit profile. And over time, a strong credit score can unlock major financial advantages. For example, imagine two people applying for the exact same mortgage. One has excellent credit. The other has poor credit. Even a small difference in interest rates can mean tens of thousands of dollars over the life of the loan. The same principle applies to car loans, personal loans, and sometimes even insurance rates. A strong credit score doesn't make you rich, but it can make many important financial goals cheaper and easier to achieve. That's why financially successful people often use credit cards differently than most consumers. They don't see credit cards as extra spending money. They see them as tools for building financial credibility. The card itself isn't creating wealth. The responsible behavior behind the card is. And that's an important distinction.
A credit card can either damage your financial reputation or strengthen it. The choice depends entirely on how you use it. In the next scene, we'll explore how smart users turn everyday spending into rewards, cashback, and valuable benefits.
By now, we've seen how credit cards can create debt. We've seen how interest can work against you. We've seen why minimum payments can become a trap. But now, let's talk about something more positive. What if you could use a credit card without paying interest? And what if the bank actually rewarded you for using it? That's exactly what millions of financially disciplined people do every day. Here's the secret. They never treat their credit card like borrowed money. Instead, they treat it exactly like a debit card. If they don't already have the money, they don't buy the item. Simple. Because they know that rewards are only valuable if they don't create debt. When used responsibly, credit cards can offer cashback, travel points, airline miles, hotel rewards, purchase protection, fraud protection, and other valuable benefits. Imagine buying groceries, paying for gas, or booking a vacation exactly as you normally would. Now imagine receiving a small percentage of that spending back. Over time, those rewards can add up. Some people use cashback rewards to reduce expenses. Others use travel points to help pay for vacations. The important thing is understanding where the value comes from. The rewards are not free money. They are a bonus for spending money you were already planning to spend.
That's a crucial distinction. Many people make the mistake of spending more simply to earn rewards. But spending $100 to earn $2 is not a good financial strategy. The smartest users focus on their spending habits first and rewards second. They spend only what they can afford. They pay the balance in full every month. And then they enjoy the rewards as an extra benefit. In other words, they make the credit card work for them instead of working for the credit card company. That's the difference between a smart user and a profitable customer. And it's a difference worth understanding. In the next scene, we'll examine the warning signs that a credit card may be starting to control your financial life instead of helping it.
A credit card is a powerful financial tool. But like any powerful tool, it can become dangerous when used carelessly. The problem is that most people don't wake up one morning and suddenly find themselves buried in debt. It usually happens gradually. Small decisions, small purchases, small balances. Over time, those small choices can become a serious financial problem. That's why it's important to recognize the warning signs early. The first warning sign is carrying a balance month after month. If you regularly fail to pay off your card in full, interest begins working against you. The second warning sign is using one credit card to help pay another bill. This often signals that spending has started exceeding income. The third warning sign is feeling anxiety when checking your account balance. Many people avoid opening statements because they already know they won't like what they see. The fourth warning sign is making purchases based on available credit rather than available cash. Just because the bank allows you to borrow money doesn't mean you can truly afford the purchase. Another dangerous sign is relying on future income to justify today's spending. People tell themselves, I'll pay it off later. I'll get a bonus soon. I'll receive a tax refund. Sometimes that happens. Sometimes it doesn't. And when it doesn't, debt grows. Financially successful people think differently. Before making a purchase, they ask, if I had to pay cash today, would I still buy this? That's a powerful question because it removes the illusion created by credit.
Remember this, a credit limit is not a measure of wealth. It's simply the maximum amount a bank is willing to lend you. Those are two very different things. The earlier you recognize these warning signs, the easier it is to correct course, because debt problems are much easier to solve when they're small. In the next scene, We'll explore the habits of people who use credit cards successfully without falling into the traps we've discussed. At this point, you might be wondering, who actually wins the credit card game? Is it possible to enjoy the benefits of credit cards without falling into debt? The answer is yes, and the difference usually comes down to a few simple habits. Financially successful credit card users don't have secret information. They don't have special privileges. What they have is discipline. The first habit is simple. They pay their balance in full every month. Not most of it, not almost all of it, all of it. By doing this, they avoid interest charges completely. The second habit is that they track their spending. They know exactly where their money is going. Many people check their credit card balance only after they've already spent the money. Successful users monitor their spending before it becomes a problem. The third habit is that they use credit intentionally. Every purchase has a purpose. They're not buying things because they're bored, stressed, or influenced by advertising. They're buying things they planned to buy anyway. The fourth habit is setting automatic payments. Life gets busy. People forget things. Automation helps eliminate costly mistakes. Another important habit is keeping credit utilization low. Just because a card has a high limit doesn't mean it should be fully used. Successful users understand that flexibility is valuable, and flexibility disappears when debt becomes too large.
Perhaps most importantly, they never try to impress other people with borrowed money. Many financial mistakes begin with the desire to appear successful. A bigger car, more expensive clothes, luxury purchases. But truly wealthy people often focus less on appearances and more on long-term financial security. They understand a powerful truth. Financial freedom feels better than looking rich. The habits we've discussed may seem simple. That's because they are. The challenge isn't understanding them. The challenge is practicing them consistently. And consistency is exactly what separates successful credit card users from those who struggle with debt. In our final scene, we'll bring everything together and answer the big question. Is a credit card a friend or a trap? So, after everything we've discussed, we're finally ready to answer the question that started this video. Is a credit card a friend or is it a trap? The truth is, a credit card is neither. A credit card is simply a tool. And like any tool, its value depends entirely on the person using it. A hammer can build a house or break a window. A car can take you to new opportunities or cause serious problems if driven recklessly. Credit cards work exactly the same way. Used responsibly, they can help build credit, provide rewards, improve financial flexibility, and make everyday transactions more convenient. Used carelessly, they can create years of debt, financial stress, and missed opportunities. The card itself is not the problem. The real issue is behavior, the habits, the decisions, the discipline. Throughout this video, we've seen both sides. We've seen how interest can quietly turn small balances into large debts. We've seen how minimum payments can create the illusion of progress. We've seen how rewards can benefit disciplined users, and we've seen how strong financial habits can transform a credit card from a liability into an asset. Perhaps the most important lesson is this. Never allow a credit card to decide what you can afford. Your income decides that. Your budget decides that. Your financial goals decide that. The credit card is simply the method of payment, nothing more. If you remember that one principle, you'll avoid many of the mistakes that trap millions of people every year. Because financial success is rarely about having the perfect credit card. It's about having the right habits. And the good news is that habits can be learned, starting today. Starting with your very next financial decision. So, the next time someone asks, is a credit card a friend or a trap? You'll know the answer. It's neither. It's a tool. And whether that tool builds your future or damages it depends entirely on you. Thank you for watching. If you found this video helpful, consider subscribing to the channel. Because here, we make finance simple.